Before you place your next trade, ask yourself this: who really wants to buy at this price? And who wants to sell? Once you understand that, the entire Forex market becomes clear. Today, we break down supply and demand the simplest way to see price logically. Demand is where buyers step in. Supply is where sellers step in. Just like any real marketplace, when something becomes cheap, demand rises. When it becomes expensive, supply increases. In Forex, these zones are created because large institutions enter positions in bulk. Think of them as institutional footprints. You'll see price rise from demand zones because that's where buyers are concentrated. And you'll see price drop from supply zones because that's where sellers are waiting. It's a constant battle between buyers and sellers, and these zones show us where the major battles are being fought. The charts don't lie. They're showing you where the big money is moving. Before analyzing zones, you must identify the trend. Is the market in an uptrend, making higher highs and higher lows? If so, demand zones have a much higher probability of holding. Buyers are in control, so you want to trade with them. Is it in a downtrend, creating lower lows and lower highs? In that case, supply zones are stronger. Sellers are pushing the price down, and you should be looking for opportunities to join them. What if the market is in a range, bouncing between equal highs and lows? This means both sides are building up their positions, accumulating liquidity. Before the next big move, your trend is your filter. It tells you which side has the strength. Always follow the strength, not your opinions. Market structure shows who's in control. When you see higher highs and higher lows, it's a clear signal that buyers are winning the battle. They are consistently pushing the price to new heights. On the other hand, when you see lower highs and lower lows, sellers are in command. They are overpowering the buyers and driving the price down. The real magic happens when the structure breaks. A break of structure often signals that momentum is shifting from one side to the other. This shift leaves behind fresh supply or demand zones, which become key areas to watch for future price action. So, what exactly is a demand zone? Demand zones form when price drops into an area, consolidates for a moment, and then explodes upward with strong momentum. What you're looking for is a sharp move away from a price level, which often causes a break of the previous market structure. This powerful move usually leaves behind an imbalance, a gap in price that looks like a large, inefficient candle. This area is the origin of the move. When price eventually returns to this zone, institutions often reload their positions, treating it as a wholesale price to buy again. The key ingredients are a sharp rally, a break of structure, and an imbalance left below. These are the wholesale price zones where smart money is likely to be active. Supply zones are the complete opposite. You'll see price consolidate in an area, then sell off aggressively, breaking the market structure to the downside. This creates a fresh supply zone. When the price returns to this area, sellers who initiated the original drop often step in again to defend their positions, unless the overall trend has shifted against them. To identify a strong supply zone, look for strong bearish candles that show conviction, an imbalance left behind by the fast drop, and a clear break of structure. Think of these as the institutional selling areas where large orders are waiting. Now let's talk about liquidity. Equal highs and equal lows on the chart act as liquidity pools. Why? Because many retail traders place their stop-loss orders just above or below these obvious levels. This makes them very attractive targets for big players who need that liquidity to fill their large orders. Another key concept is imbalance, also known as a fair value gap. This occurs when price moves so fast in one direction that it leaves a literal gap, or a very large candle body with small wicks, creating an inefficient price area. Markets are like magnets. They typically revisit these areas to fill the gap and make the price action more efficient before continuing in their intended direction. Finally, we have a liquidity sweep. This is a classic maneuver where price spikes just above a level like equal highs, grabbing all the stops, and then immediately reverses, wicking down and moving in the opposite direction. It is a quick grab of stops before the real move begins and often happens at the edges of trading ranges. Understanding these liquidity concepts is crucial for avoiding traps. So, how do you put this all together to find a high probability direction? It's not about a guarantee, but about building a logical case based on market behavior. Here's a simple checklist. First, identify the overall trend. Is it up, down, or ranging? Second, confirm the market structure. Who is in control, buyers or sellers? Third, locate the key liquidity pools, like equal highs or lows. Fourth, find the supply or demand zone that caused the most recent break of structure. And finally, check for any imbalance that needs to be filled. When these 5 elements line up, you get a high probability direction. Let's look at a simple beginner example. Imagine we're in a clear uptrend. Price pulls back into a fresh demand zone that previously broke structure. As it pulls back, it fills an imbalance that was left behind. Far above, you can see clear equal highs, which act as a magnet for price. The logical expectation is for price to react from the demand zone and target the liquidity resting above those equal highs. This isn't prediction. It's about reacting to the story the chart is telling you through structure, liquidity, and zones working together. Supply and demand isn't about guessing. It's about reading the logic the market leaves behind. Thanks for watching. If you'd like a full live chart breakdown using these concepts, check the next video.